It has been quite the ride for DLR stock so far, with a 42% increase year to date in stock price. And one of the reasons why people like REITs in general, or particular DLR stock, is because of the dividends. Current dividend yield is sitting at 2.5%, which is pretty decent. Taking a quick peek at the total returns, we see that DLR slightly underperformed the S&P 500, but it is really getting some momentum in recent periods. So is DLR stock a buy at current prices, or is this REIT massively overvalued? Let's dive into the recent earnings and do a full analysis on DLR stock. Diving into the earnings, we see that DLR reported actually pretty decent earnings, with FFO in line with expectations and a beat on revenue. Revenue was reported at 1.4 billion, up 5% versus the previous quarter, and up 2% year over year. So we are off to a decent start here. Net income was reported at 9 cents versus $2.31 last year. So that's something to dive into in a minute. FFO per share, one of the most important numbers here, was reported at $1.67, up from $1.62 last year. So this part is looking pretty good. Looking at some interesting numbers, we see that in the recent quarter, DLR had 312 properties and data centers in its portfolio. The top 20 tenants represent 50% of the ABR, which is way too much in my opinion. So let's check the diversification in a minute as well. Net debt to EBITDA is actually looking really good at 5.4 times. This is perfectly in my preferred range of 5 to 6.5. DLR has B credit ratings, which is not the worst, but I would prefer A credit ratings here. Looking at the weighted average lease term, we see that this number is sitting at 4.8 years, which is insanely low. Most leases expire in or after 2025, which worries me a lot. This is almost 25%. This could be a potential red flag to me. DLR itself says that this is a potential repricing opportunity, so definitely keep your eye on this number, because if they play it well, it actually could turn out very well for the company. But still, 2026 and 2027 is also looking not that great either. Now let's take a look at the portfolio breakdown. About 37% of the tenants have a cloud focus. Network and content are sitting at 16 and 15% respectively. To me, this looks pretty decent. About 48% of the customers are investment graded. Moving on to the top 20 customers, we see that they represent around 50% of the ABR, which is a lot. I prefer a range of 20 to 30% here, highly depending on the business of course. Lucky for us, we do see a lot of big names in here, and the individual tenants are actually not looking that bad, with the biggest sitting at 11.2%, and I prefer a 10% maximum here, so it's almost there. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. DLR is a 65 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting a little over 34, indicating they are massively overvalued. Later in this video I will show you my 3 price targets for DLR stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 5.5 billion, and in this graph we see that revenue went up in the long run. However, most recently revenue isn't going anywhere. So we got a massively overvalued company that isn't growing in revenue. How are the margins looking? Well, we see that both the gross margin and operating margin are decreasing over a longer period of time. Net margin is kinda going up and down a lot, which is also not ideal. EPS is pretty much the same story as the margins, so keep an eye on this number as well. Analysis expect that in the coming years EPS will decrease even further. To me, this also doesn't look good. The silver lining is that in 2026 it is expected to see big increases again. For the revenue, it is looking pretty similar. It is expected that from 2025 on, revenue will start to increase at much higher numbers again. Return on assets is sitting at 1%, which is a low number for a REIT. Return on equity is looking terrible at 2%. And the most important number, return on invested capital, is sitting at 1.2%, which is again a low number. And it is slightly lower versus the 5-year average, so that's also a bad sign. Current ratio is at 1.6, which is a decent number on its own. But as a matter of fact, it is increasing quite a lot over the recent years, so keep your eye on this number as well. Especially if we take a look at their debt levels. DLR has 18.5 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. DLR has 2.2 billion in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends, and all other things. And finally, some good news. Free cash flow is going up at a pretty decent level over the years. For a REIT, this looks really good. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the P/E ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 2.5%, which is a decent number. To be honest, it is not the highest for a REIT. Annual payout is at $4.88 and payout ratio is at 73%, which is slightly below the 75% average for REITs. The 5-year growth rate is sitting at almost 3%, which is a really low number, and there are no consecutive years of dividend increases. And that's also reflected in this graph, where there is no dividend growth anymore since 2022. To me, this is not a good sign at all. In this graph, we see the expected dividends in 2024, 2025, and 2026. Of course, this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to slightly increase from here. And overall, these dividends look not that great to me. But how about the historical returns? I decided to compare DLR stock with the overall market. In this case, the S&P 500. Next to that, I added EQIX. On the 5-year chart, we see that DLR returned 92%, which is actually not bad for a REIT. This is including dividends. But still, we see that the S&P 500 outperformed both REITs with a decent margin. On the 1-year chart, it looks very interesting, with a 46 return for DLR, massively outperforming the other two in this list, also impacted by the recent earnings. On the 6-month chart, it is again DLR who is crushing the other two in this list with a 36% return, twice the amount of the S&P 500. On the 1-month chart, it is again DLR who is winning here. So bottom line, DLR underperformed the S&P 500 in the long run, but in the short run it is actually looking pretty good for this stock in terms of momentum. So could this be the perfect time to buy DLR stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth, I'm filling in 8, 10 and 12%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin, I'm filling in 16, 17 and 18%. And for the free cash flow margin, I'm putting in 40, 42 and 44. For the PE ratio, I'm putting in 20, and for the price to free cash flow, I'm putting in 18, 19 and 20. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now, DLR stock is around $192. I hit analyze, and we see a lot of red numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $126. We have a mid price target of $159, and we have a high price target of $200. And to me, the low to mid price target is the most justified here, indicating that this stock is overvalued quite a lot. And which price target do you think is the most justified here? Let me know in the comments down below. My final conclusion on DLR stock is that it is an interesting company. The business itself is actually pretty attractive, also looking into the future. However, there are quite a few concerns with this particular business. Revenue is slowing down a lot lately, and it seems that a lot of leases are expiring as well in the coming 2 to 3 years. And this combination is a big red flag to me. Usually when this event happens, you want to see margins going up a lot. But that's not really the case with DLR, so that's another red flag to me. On top of that, the dividends aren't looking that great either. A 2.5% dividend yield isn't too bad, of course, but as a REIT you will find better yields out there, with better growth rates and a better track record. Finally, the valuation, which to me is completely off. It is massively overvalued by many indicators, so down the line I'm skipping this stock. But I will keep them on my watch list to analyze every now and then, since the business itself is very interesting. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and that did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.